Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about an ethics proposal. So the Professional Ethics Executive Committee, or PEEC, has proposed a revision to the ethics rules regarding loans, acquisitions, and other transactions. Now, this is not unexpected. We have been tracking this progress on the blog because the Professional Ethics Executive Committee had to issue a temporary policy statement regarding Regulation SX. And so the SEC issued a change on their ethics, and that could mean that for some firms, the differences would put them out of compliance with one and in compliance with another. And so as a result, they put out a temporary enforcement policy that said so long as you're following one or the other, that you would be deemed to be in compliance with the professional ethics for the AICPA. And so that is a temporary policy. They said that they were going to look at the changes in the SEC changes and see what they wanted to do in terms of convergence. So this was issued on October 5th, 2021. Comments are due January 5th, 2022. I'm starting to see that number pop up more and more. So again, it is an SEC convergence item to make it more consistent between the ethics standards of the AICPA and the ethics standards of the AICPA. And so first and foremost, they do make an update to the definition regarding beneficially owned. It was interpreted by some to mean that it did not include financial interest held by a record owner. And they believe that this edit, you can see here, they removed that. Clarifies that the definition does include financial interest held by an individual or entity who may or may not be the record owner. And so again, just a little bit of clarification there. And then there's a lot on client affiliates, again, trying to help understand when we have to follow various standards regarding financial interests. And it also addresses when I acquire an entity and it becomes an affiliate, or when some other transaction creates a new affiliate, what are the transitions that we have here, right? So if I have a loan and then my bank acquires another bank, I was in compliance, and now I have an affiliate that I have to go through, and how does that impact us? And so they're going to give some transition guidelines there. In the area of loans, they do make a change regarding the hardline 10%, and instead they talk about who have the ability to affect decision-making, or any individual here again with that beneficial ownership interest known through reasonable inquiry that gives the individual significant influence over the attest client. And so again, a little bit of clarification here. The final SEC amendments provided certain elements, and so they wanted to make sure that this was consistent with that beneficial interest, and again, sends us to the loans. Now, in this scenario, they do make a couple of big changes here in you can see that 10% removal. But what's more interesting is in the section on home mortgages, other secured loans, and immaterial unsecured loans and student loans. So you can see first off, they changed the title. Then they also added that paragraphing there to talk about how this works out. And this really came out because of student loans, right? As we all probably are aware, it's not inexpensive to go to college and university these days. And you take out those student loans well before you get your first job. And so whoever is holding your loans at that point in time, those are the loans that you have. And so the SEC wanted to make it a little bit easier here for individuals who have student loans, who have obviously entered into them well before they ever gotten started. They also did not decide to define what student loans were allowed to pay for. For example, it didn't talk about, whether it was for tuition or room and board or books. It just said any student loan. And it doesn't provide a materiality threshold. So you can see here that they kind of made some big modifications to the titling of this. And then you can see here that one of the biggest things that they do is they basically change it to say that they would permit student loans from a test client that is a lending institution if the student loan was obtained prior to becoming a covered member or the immediate family member prior to becoming a covered member. So again, even if this is a child or a family member within the spouse, for example, the student loan was obtained under the normal lending procedures, terms, and requirements, and then the student loan is kept current, and there are no changes to the terms of the student loan. So you can kind of see here that they made some pretty big modifications. They took out that, again, some of the key elements in the language regarding materiality, and just kind of kept it as we know student loans are expensive. And so as we go through this, I think they tried to clean this up and make it a little bit more interesting. And then for other loans, again, the final SEC amendments permitted any consumer loan that an audit client, with an audit client that has an aggregate outstanding balance of $10,000 or less. So you'll see here something very consistent where they talk about the aggregate outstanding balance on a current basis, take into consideration payments due and any available grace periods. So again, just kind of bringing us in line with the SEC. Because this is already effective for the SEC, they technically could have made it, implemented upon issuance, but they did not. Thankfully, they decided that there are a lot of entities who are not subject to the SEC amendments and might need time to evaluate this and implement it, put it into their work, etc. And so they're going to make it effective. The proposed date is 3 months after it's published in the Journal of Accountancy. Again, the Journal of Accountancy is how they announce new ethics standards, and so this would be their time period, 3 months basically, to implement. Early implementation would be allowed, especially for those who are already following the SEC policy. All right, so again, very niche area, but again, trying to mitigate differences for firms who do have to follow multiple ethics rules. Thank you guys so much for joining. I hope to see you on next week's blog. Have a great day, guys. Bye-bye.